I'm Ben Reppond. Welcome to my YouTube broadcast. Today is Wednesday, October 23rd, 2024. I'm going to begin with a little bit of a commentary. Here we are on the 23rd of October. The 5th of November is not far away, maybe about 2 weeks away. And so we have an election coming up. So I would say we live in a democratic society, so we all get the opportunity to exercise our vote. So hopefully you will do that. You'll get out and vote for the candidates you think will do the best job. And it's just a reminder that let's all vote. So we have that privilege, that right that we have, the right to vote. Okay, so I'll begin with the dashboard. Today is the 23rd of October, looking back to last Friday, which was the 18th of October. My data is through last Friday. I put the weekly data in the yellow box and the year-to-date data in the pink box. So this gives us 6 equity indexes, 4 U.S., Dow, NASDAQ, S&P, and Russell 2000 Small Cap Index, and 2 foreign indexes, the developed markets, EFA, and the emerging markets, EEM. And then the long-term government bond, TLT, 20-year government bond. So they're kind of listed, in the top 6 are the equity ones, domestic and foreign, and then the 7th one is the bonds. And then to the right of that is the pink box, which is the, you can see they go from the S&P at 22%, down to NASDAQ at 20, Dow at 14, et cetera, all the way down to 7% for the developed markets, EFA. And then at the very bottom, in the pink box, at the very bottom is the long-term government bond, TLT, as an ETF, down 6% for the year. So it's down for the week and down for the year. And it's been moving the last 2 or 3 weeks, has been moving down. So, and you can see over to the right of that, the green dots are the red dots. The green dots are the ETFs, which are above their moving average, and the red dots are the ones that are below their moving average. So clearly you see that TLT at the very bottom, the long-term government bond, is below its 20, 50, 100, and 200-day moving averages. So it has definitely come back down. And so when I look at this, I think traditional 60-40 portfolios. So traditional portfolios have some equities and some bonds. So you'd say, okay, the equities, what's in a portfolio, it varies a lot. So I don't even want to quote a number. Bonds, same thing. They vary quite a bit. You have the long term, but you have the intermediate term, you have corporate bonds, et cetera, that are in portfolios. But when you get a blend of those two, you're probably down in single-digit territory, maybe even lower single digits, I'm not sure. But year-to-date, that the bonds are putting a pretty big drag on the traditional 60-40 portfolios. The S&P 500 breaks down into its component parts. There are 11 sectors inside the S&P 500. These are the 11. And I order those from top to bottom in the pink box. So the pink box is year-to-date. So going from top to bottom, financials, number 1. That's interesting. Financials, industrials, technology, telecommunication, consumer staples, basic materials, et cetera. Very interesting mixture of sectors. Normally you don't find those that are grouped together like that. Going all the way down to the bottom 2, which is energy and retail, so which are single digits. 5 out of the 44 possible dots, 5 of them are red dots, meaning they are below their moving averages. So the consumer staples and healthcare, which are typically very defensive sectors, are below their 20 and their 50-day moving averages. and energy is below its 20-day. So, I just find this whole thing quite interesting. It tells you quite a story. And on the last week in the yellow box, it's mixed. What was down the most by far was energy, down 2.6%. Next to that was healthcare, down 1.5%. And there were some that were up quite a bit. Retail and financials were up quite a bit. So anyway, mixture, but because when you look at the right, get the more macro view with the green dots and red dots, you would see clearly it's a really more of a positive market. Even if it might have been a little mixed this last week, over a period of time, you'd say it's definitely mixed. Okay, the S&P 500, this is the line chart, which is a weekly line chart for the last 30 months. So one move in this chart equals 1 week. And I'm taking it from October of 2022 to present. So that's about 2 years in my black line. So you see that black line is going in an upward direction, going from a bottom in 2022 up to where it is today. Again, staying quite a bit above the 20-period moving average. I take that same chart and put it on a candlestick chart, and it looks about the same, but it tells you, at least for the last couple of years, the degree to which it is going up. And because that'll be represented by a hollow candlestick, meaning it started here and it finished up here. If it's a red candlestick, it means it started the week here and moved down through the week. And most of them are that. There are some that are, not quite a full red candlestick or not quite a hollow candlestick, but most of them are one or the other. And so you can see it shows me that during most of this period of time that the market has been moving up, and within each week it has been moving up. So here we are still sitting at the very far upper right with quite a bit above the 20-period moving average. This is a relative strength chart showing the NASDAQ compared to the S&P 500 broad market. So when it goes, this line chart, when it goes up, it favors the NASDAQ 100 growth stocks. When it goes down, it favors the broad market, which is a mixture of growth stocks and value stocks. I put two lines on here, two arrows, to show you two views. One is a more intermediate term view from the black line, the black arrow, showing from the beginning of 2023 to present. So that would be about 19 months or so. Clearly moved in an upward direction. But when you go back for the last 3 or 4 months, you can see the red arrow that there is a downward direction, which shows that the S&P 500 in the last few months has been more dominant than the NASDAQ 100. This is also a relative strength chart showing the growth stocks inside the S&P and the value stocks inside the S&P. So the growth stocks, SPY-G, when this moves up, it favors growth stocks. When it moves down, it favors value stocks. So you can see over that 19-month period also that mostly it's favoring growth stocks. But there are periods of time, and you've seen them in the past few months, where value has been more favored. Another relative strength showing the S&P 500 as a numerator and the small cap Russell 2000 small cap ETF, IWM, as the denominator. And so when it goes up, that favors the broad market, large cap stocks, S&P 500. And when it goes down, it favors small cap, the Russell 2000 small cap index, IWM. So you can see over that period of time, macro, you would say probably large cap is in favor. But there are periods of time where when it goes down, that small cap came into favor, but that didn't last very long. So the next chart, I talked about this earlier. The next chart is the TLT, the ETF TLT, long-term government bond, and it's a 5-year chart, so it's a weekly chart. So one move equals 1 week, but it's compressed. 5 years of data is compressed. So you can see that the two things, the long-term direction in 5 years is down. What that tells you is that interest rates and bond yields, because they are correlated, bond yields are up, interest rates are up, and therefore, inversely correlated, the price of bonds is down. And it has been going down for most of that 5-year period. The other thing that I notice is at the very end of this, the last 3 to 4 weeks, I think approximately the last month, you can see that the price of bonds has been coming down. It went up, now it's coming back down, which tells you that interest rates and bond yields are actually on their way back up. And again, as I said earlier, this is not good for traditional portfolios. But I don't know. I don't want to predict anything into the future because I don't do that. But when you look at this, you'd say it's not good for traditional investors and traditional portfolios. Okay, the dollar, conversely, the dollar is rallying. And it is going up. It came back down below its 20-period moving average, and now it's on its way back up. And when you look over the last 3.5 years, 42-month chart, you can see that, the trajectory is that the dollar is going up. Now, you may think that the dollar is weak because of the dollars in circulation, printed money, etc. But, relative to other currencies, it's basically pretty strong. Gold, represented by the ETF GLD, continues to go up, and it has stayed for quite a while above, I guess about a year, it stayed above its 20-period moving average. Pretty interesting. And I guess I could say it's rallying, but I don't want to be too optimistic about it, but it's definitely looking good. If you own gold or silver, I'll show you silver next, but you own gold or silver, this is a very strong market for gold. I'm a fan. I'm probably one of very few out there that are financial advisors that are actually fans of gold. A lot of them, bash it and tell you it's a terrible investment and so forth. And I don't agree with that. I've never agreed with that. So it doesn't matter what direction gold goes. I don't look at it that way. So, but I think it's a good asset to own, and it does something very different than equities do. It does something very different than bonds do. And it is an insurance policy against a decline of the dollar, eventual decline of the dollar, or the if the dollar basically goes away as our currency, you need something to replace that. And so I think gold and silver do that. Okay, the next one is silver. So silver is kind of like gold, except silver is more volatile. It goes up more and it goes down more. So you saw gold was more, particularly the ETF GLD, particularly more a smoother move, whereas silver bounces more. But when you look at the ETF, looking at the base of my black arrow, the base of that is at about 20, and the upper right corner is 30. So that's an increase in value of about 50%. So, and definitely moving up. Bitcoin has been kind of in a sideways move, going up and down quite a bit for the past 6 months or so. This last week it was down a little bit, but again, it's mostly up and down, but more down than up. The volatility index, now this is interesting because a lot of the stocks, as you saw, most of them are sectors and indexes were positive, not 100%, but many were. But it's interesting, volatility index tends to go in an inverse direction to the equities or equity indexes. But here the volatility index is actually up. And it's up to around 18, 19 right now. And so and I put a black arrow on to just show you the short term, the last few months, direction of the volatility index, definitely moving up. I did not put my mark up there at 24, but you see where it is, and if it starts moving above that, in my opinion, typically it keeps going, which means the market tends to decline. Asbury 6, I think this is the 4th week in a row that they have had 5 out of 6 of their indicators that have been positive, and 1 is negative. What's been interesting is that the one that's negative keeps changing places. There's a different one that's negative, but this is still 5 out of 6. Cross-asset relative performance. So a good comparison. Stocks more favored than bonds. Blue chips Dow more favored than the broad market. And the broad market more favored than the NASDAQ 100, the growth NASDAQ 100. U.S. markets more favored than foreign markets. And then down in bonds, high yield is more favored than high quality. And short term is more favored than long term. In the world, again, 2nd week in a row, Peru has outperformed the U.S., not the economy, not the currency, but the market. Peru has outperformed the U.S. for the last week, the last month, the last quarter. And this time, Taiwan comes in, and it has outperformed the U.S. last week, last month, last quarter. And the U.S. has outperformed Chile, Brazil, Mexico, Spain, Japan, South Korea, Thailand, and Australia. I've been using South Korea as my indicator here. The ETF is EWY. Look at the degree to which the U.S. market, stock market, SPY, has outperformed EWY, which is the Korean stock market in general, broad market. Interesting, isn't it? Quite a bit above its 20-period moving average. Gold and silver. Gold is now $27.53 per ounce spot price. That is an increase of 2.7% over the previous week. Silver is spot price, $33.71, an increase of 8% over the previous Friday. And then on top of that, you add the markup. When you look at the monster box of silver, 500 generic ounces rounds, is now $17,000. It wasn't too long ago. I remember reporting this when it was down around 11 and 12,000. It's now up to 17,000. And that includes a $1.17 markup, which brings that $33 price up to $34.88 when purchased. I'm just using an example of 500 rounds. And I get my information from my son, Preston. So the bull is complaining to the bartender, my reality check bounced. The bulls are in control. And the bears are fighting, trying to get a hold and push the market down. So far, it hasn't happened. Thank you for watching. If you have questions or comments, leave them in the comment section below.